Two people can pay into Social Security for the same number of years, earn the same wages, and end up with monthly checks that differ by more than $2,000. That isn't a rounding error. Those are the Social Security Administration's own maximum benefit figures for 2026. $29.69 a month at 62, $51.81 at 70, same worker, same earnings record, one decision. So what separates the retirees who keep their money from the ones who quietly hand it back? 40 rules. Let's go. How does one household lose 6 figures over a 30-year retirement while the one next door, with nearly identical savings, holds on to almost all of it? Almost never through a bad investment. It happens through timing, sequence, and paperwork, which are 3 things nobody puts on a brochure. Every rule in this video is one of those 3. A claiming decision, a tax decision, or a deadline. All 40 are available to you right now in 2026, and a handful close on December 31st. Stick around to the end, because laws 38 through 40 are what make the other 37 actually happen. Law 1. Know your actual full retirement age. If you were born in 1960 or later, 2026 is the year it finishes its long climb to 67, not 65. 65 is when Medicare starts, and confusing those 2 dates costs people real money every single year. Law 2. Claiming at 62 is a permanent reduction, not a temporary one. The check does not correct itself when you reach 67, and every cost of living adjustment you receive for the rest of your life gets applied to that smaller starting number, so the gap widens every year instead of closing. Law 3. Between your full retirement age and 70, delayed retirement credits add roughly 8% a year to your benefit. That is an inflation-adjusted increase guaranteed by statute that you cannot buy anywhere at any price. Law 4. Those credits stop dead at 70. Not 71, not 72. Every month you delay past your 70th birthday is a check you simply never collect, so waiting out of caution once the credits have maxed out is pure loss. Law 5. Don't claim early to beat a break-even age you cannot calculate. Break-even math requires your date of death, and nobody has that number. Pay attention to the next 5 because they explain why so much of this goes wrong for people who are still working. Law 6. If you are under full retirement age for all of 2026 and collecting benefits, the earnings limit is $24,480. Earn above that and Social Security withholds $1 for every 2 you go over. Law 7. Almost nobody hears this part until it's too late to plan around it. That withholding is not a penalty, and it is not lost. At full retirement age, Social Security recalculates your benefit and credits you back for the months withheld. The money comes home just later, spread across the rest of your life. Law 8. In the calendar year you actually reach full retirement age, the rules loosen considerably. The limit jumps to $65,160, and the withholding rate drops from $1 in 2 to $1 in 3. Law 9. From the month you hit full retirement age onward, there is no earnings limit whatsoever. Go back to work full-time, take a consulting contract, run a business, your benefit is untouched. Law 10. Your benefit is calculated from your highest 35 earning years. If there are zeros or thin years sitting in that calculation, and for anyone who took time out to raise children there, usually are, one more solid working year replaces the weakest one and permanently raises your check. Law 11. Social Security is taxed based on something called provisional income, and here is the part that catches people. Those thresholds have never been indexed to inflation. $25,000 and $34,000 for single filers, $32,000 and $44,000 for joint filers, unchanged since the 1980s and 90s, while everything else roughly tripled in price. Law 12. For 2026, taxpayers 65 and older get a $6,000 bonus deduction stacked on top of everything else, courtesy of the One Big Beautiful Bill Act. Law 13. So stack it properly. A single filer 65 or older shelters $24,150 of income in 2026, and a married couple where both spouses are 65 or older reaches $47,500 before $1 of federal income tax is owed. Law 14. That bonus deduction phases out as income rises. It begins shrinking at $75,000 for singles and $150,000 for couples, and is gone entirely above $175,000 and $250,000. Law 15. It is also temporary. As currently written, it covers tax years 2025 through 2028 and then vanishes, which leaves 3 filing seasons to use it. Build your plan around the expiry date rather than around the deduction. Law 16. Every extra dollar of ordinary income you withdraw can pull more of your Social Security into the taxable column alongside it. The withdrawal and the tax on your benefit are not 2 separate events. They are one decision with 2 price tags. If that sounds like a lot of moving parts, the next 6 are where the biggest money quietly leaks out. Law 17. The standard Medicare Part B premium in 2026 is $202.90 a month, and the Part B deductible is $283. Law 18. Medicare looks back 2 years to set your premium. Your 2026 premium was determined by the tax return you filed for 2024, which means the return you file next spring is already writing your bill for 2028. Law 19. ARMA-A is a cliff, not a slope. Go $1 over $109,000 as a single filer, or $218,000 filing jointly, and you owe the entire surcharge for the whole year. There is no phase-in and no proration. Law 20. Crossing that first line moves you from $202.90 a month to $284.10, and it applies per person, so a married couple where both spouses are on Medicare pays that increase twice for the same single dollar of extra income. Law 21. At the top tier, the premium reaches $689.90 a month. That's over $8,000 a year per person for coverage that is completely identical to what your neighbor gets for around $2,400. Law 22. If your income dropped because you retired or because your spouse died, you can appeal the surcharge. The form is SSA-44, and it exists precisely so that you are not billed on income you no longer have. Law 23. Taxable accounts first, then tax deferred, then Roth. That is the default order, and it works for most households, but plenty of situations call for breaking it deliberately. Law 24. The years between the day you stop working and the day required distributions begin are the cheapest tax years you will ever have. Low income, full deductions, nothing yet forcing money out. Law 25. So don't coast through them. Deliberately fill the low brackets with income you are always going to be taxed on eventually, because an empty low bracket is a discount you let expire. If the first 22 have been useful, hit subscribe. I go through the Social Security and Medicare rulebook every week in plain English with the actual current numbers, and if the claiming decision is the piece you're still stuck on, I put together a claiming order map that walks through the sequence for your specific situation. Links in the description below. All right, so here's where it gets genuinely technical and where the largest dollar amounts tend to hide. Law 26. Roth conversions during those gap years do 2 jobs at once. They move money into an account that is never taxed again, and they shrink the balance your future required distributions are calculated from, which shrinks every forced withdrawal that follows. Law 27. But watch the cliff on the way through. A conversion you do this year sets your Medicare premium 2 years from now, so convert right up to the ARMA-A line and then stop. Law 28. Long-term capital gains have a 0% bracket. In a genuinely low-income year, you can realize gains, owe nothing on them, and reset your cost basis higher for free. Law 29. Your required minimum distribution age depends entirely on your birth year. It's 73 if you were born between 1951 and 1959, and 75 if you were born in 1960 or later. Law 30. Miss one and the penalty is 25% of the amount you should have taken, which is not a typo. Correct it within 2 years and it drops to 10. Law 31. Roth 401k accounts no longer carry lifetime required distributions. If yours is still parked in an old employer plan from a job you left years ago, that rule change now works quietly in your favor. Law 32. From age 70 and a half, you can send up to $111,000 in 2026 directly from an IRA to a qualified charity. It counts toward your required distribution and never touches your adjusted gross income, so it never touches your Medicare surcharge either. Law 33. and the order within the year matters more than people expect. The first dollars out of your IRA are treated as your required distribution, so make the charitable transfer before you take anything else out. Law 34. The higher earner's claiming age sets the survivor benefit for whoever lives longer. That turns claiming into a joint decision, and it is the most overlooked reason for the higher earner to delay. Law 35. When one spouse dies, the household keeps the larger of the two checks and loses the smaller one entirely. Then the following year, the survivor files as a single taxpayer, facing narrower brackets and lower IRMA thresholds on an income that barely moved. Law 36. A spousal benefit maxes out at half the worker's full retirement age amount, and delaying your own claim past your full retirement age adds nothing to it. Delayed retirement credits apply to your own benefit only. Law 37. If you were married for at least 10 years, are now divorced, and have not remarried, you may be able to claim on your former spouse's record. It doesn't reduce anything they receive, and they are not notified that you filed. Law 38. Pull your earnings record from your My Social Security account and read it line by line. Employer reporting errors do happen, and once they're in there, they are yours to notice and prove. Law 39. Write the plan down. Which account you draw from, in what order, in which month. A plan that only exists in your head stops working the moment you are not the person making the call. Law 40. Nearly every rule in this video attaches to a calendar year rather than to your birthday. Conversions, gain harvesting, charitable transfers, bracket filling. December 31st closes doors that January cannot reopen. Now a fair warning, because these are defaults and not gospel. Claiming at 62 is the right call for plenty of people, including anyone in poor health, anyone with no way to bridge the gap to 67, and anyone caring for a qualifying child. Roth conversions are the wrong move if you're already sitting in a high bracket and genuinely expect a lower one later, and if charitable giving isn't part of your life, laws 32 and 33 simply don't apply to you. The rules are the starting position. Your situation is the override, and a licensed professional who can see your full picture beats a list on the internet. Screenshot this one. 4 numbers decide more than the other 36 combined. 24,480 for the earnings test. 109 and 218,000 for the IRMA cliff. 24,150 and 47,5 for the senior deduction, and 73 or 75 for your required distributions. So the real question isn't which of these 40 you agree with, it's which one has a deadline this year that you haven't looked at yet. Subscribe, and next week I'm breaking down the survivor benefit trap in full, because Law 35 deserves an entire video of its own.